Talmud wisdom. On diversification, the 1/3 rule. A person should always divide his money into 3 parts. 1/3 invested in land, 1/3 in business, merchandise, and 1/3 held in hand, cash. Tractate Bava Metzia 42a. The lesson. This is one of the world's oldest portfolio diversification strategies, balancing stability, growth, and liquidity. This piece of wisdom from the Talmud is essentially the ancestor of modern financial planning. Written nearly 2,000 years ago, it addresses a fundamental human problem, the uncertainty of the future. The rabbis understood that if you put all your money in one place, a single piece of bad luck could ruin you. By splitting wealth into these specific 3 categories, they created a balanced portfolio that manages 3 distinct types of risk. 1. The 3 categories explained. 1/3 in land, stability, safety, the ancient context, owning a field or a vineyard. Land doesn't disappear, it doesn't rot, and it can't be stolen easily like gold. Modern equivalent, real estate or blue chip, low-risk bonds. The purpose. This is your foundation. It is low growth but high security. If the economy crashes, you still have the land. 1/3 in business, growth, risk, the ancient context, merchandise. Buying silk, spices, or grain to trade. You might double your money, or the ship might sink. Modern equivalent, stocks, starting a company, or investing in a friend's startup. The purpose. This is your engine. This is where wealth is actually built. It's risky, but without it, your money won't grow. 1/3 in hand, liquidity, opportunity, the ancient context, gold or silver coins kept in a chest or buried in a safe spot. Modern equivalent, cash, high-yield savings accounts, or liquid assets you can access in 5 minutes. The purpose. This is your shield. If you get sick, you need cash. If a great business opportunity appears tomorrow, you need dry powder to buy in. 2. A plain English example. Imagine you have $90,000 total savings. According to the Talmud, $30,000 goes into a real estate fund, land. It pays a small dividend. It's boring. You forget about it. $30,000 goes into the stock market, business. 1 year it's up 20%, the next it's down 10%. This is your active money. $30,000 stays in the bank, cash. This earns almost no interest, but you sleep better at night knowing it's there. 3. Why this is genius strategy. The Talmudic 1/3 rule balances 3 competing needs that every investor has. Stability. If the stock market, business, crashes, you still have your land. Growth. If you only kept cash, inflation would eat your wealth. The business part prevents this. Liquidity. If you put all your money in land, and you have a medical emergency, you can't sell a bedroom of your house by tomorrow morning. You need the cash in hand. 4. The hidden psychological lesson. The most difficult part of this rule isn't the math, it's the discipline. When the stock market is booming, people want to move their land and cash into business because they are greedy. When the market crashes, people want to move everything into cash because they are scared. The Talmud advises a permanent 1/3 split. This forces you to be automatically disciplined, ensuring you are never too exposed to risk and never too far from opportunity.